Okay, good evening everyone. Welcome back. This is Sham Kagodia. Now, before I start the discussion, if there is any issue so far with respect to the sound, please do let me know. Or anything so far that I've covered, you have a doubt regarding that, please do let me know. Otherwise, we'll continue. We'll basically continue with the discussion then. Okay, now let's start. So, what we have discussed, exchange rate. What we have discussed so far, exchange rate, concept of exchange rate. What is an exchange rate? Basically, currencies from the domestic currency into a foreign currency and vice versa. Domestic to foreign, foreign to domestic. You're converting the currencies. At what rate you're converting, it is called as a exchange rate. We have basically two systems, but variations are there. For example, in case of India, although on the paper we say we follow floating exchange rate, but in reality it is more than floating. We follow market managed exchange rate. Okay, market managed exchange rate, meaning what? We allow the market forces to determine exchange rate, but every now and then RBI will intervene in the market and stabilize the exchange rate. Now, let me take up from that particular point the factors. What kind of factors influence exchange rate in India? What factors will have an impact on exchange rate? First one, interest rates. Right, interest rates generally have a huge impact on the exchange rate. I'll connect it to current affairs now. Please be very careful. Okay, am I visible to all of you? Some of you are saying I'm not visible. Am I visible to all of you? Just a second, just a second. Okay, now am I visible to all of you? Okay, great. Let's start then. Let's start. So what factors will have an impact on the exchange rate? Let's try and understand that. And in the process of discussing these factors, we'll connect it to certain current affairs. Let's understand one by one. First one is interest rate. Now, what is the right basic connection here? Whenever a country offers a higher interest rate, it will attract a lot of foreign investors, thereby leading to rise in the value of domestic currency. Sir, what do you mean by this? Let me explain. Imagine there is a country X. In the domestic market, that is within the country X, the interest rate has gone up. Interest rate. Now, when the interest rate has gone up, right, what do you think will happen to the coupon rates? That is on the bonds. What do you think will happen to coupon rates? Right, don't you think the yield rate in the market will go up? The coupon rates have gone up, etc., etc. Now, if interest rate has gone up, that is, if you invest, you're earning more amount of income now. Don't you think that will attract a lot of foreign investors to bring money into the country? Is it okay? If the interest rate has gone up, what is the impact of it? Foreign investors are more interested now because by investing money in the country X, they'll be able to earn more amount of interest. Now, when the foreign investors will bring a lot of money into the country X, right, what do you think will happen? Imagine dollars will flow into India, supply of dollar will increase, and demand for rupee will increase. Will it not have an impact on the exchange rate? Will it not lead to rupee appreciation and dollar depreciation? Is the first point clear with you? Is the first point clear with you? In simple terms, whenever the interest rates will increase, it will attract a lot of foreign investors, and that will have an impact on exchange rate. Now, what is the connection of this to current affairs? There is a term called as Fed tapering. Please be aware of it. There is something called as Fed tapering. Now, before I explain to you Fed tapering, let me start with the second term here, tapering. Okay, right? So, understand this. First, understand the term tapering here. What do you mean by tapering? Tapering means narrowing. Is it okay? Whenever, let's say, the road which is very narrow will become narrow, which is very broad will become narrow like this, we'll say road is tapering. Is it okay? Understand this. When the road is very broad, let's say 2-laned or 3-laned, and rather than having 3 lanes, now the road will become 2-laned, narrow. This is called as tapering. Now, what is the idea for Fed tapering? follow the points one by one. Let's understand this. Whenever there is a recession or a slowdown in a particular country, right, what do you think the central banks will do? Start with basics. Whenever there is a recession or a slowdown, right, what will the central banks in any country do? They will increase money supply. They will increase money supply. And is it okay if I also say that they will reduce interest rates? They will increase money supply and they will reduce interest rates. Now this kind of a monetary policy, right, is nothing but quantitative easing. This kind of a monetary policy is referred to as quantitative easing. QE, quantitative easing. Point number one. Now go to USA. Imagine you are in USA. Because Fed, what is the Fed here? It is a central bank of USA. Simple. It is a central bank of USA. Like we have RBI in India. In USA, they have Federal Reserve. Now let's start. Whenever there is a recession or a slowdown, what is generally seen? The central banker should increase the money supply, should reduce the interest rate. That is exactly what was done by Federal Reserve. Not recently, even in the past also, they have done it. So Federal Reserve will follow a policy called as quantitative easing, reduce interest rate, increase money supply in the market. Now, how can you increase money supply? Right? How can you increase? One, if you reduce the interest rate, automatically more and more people will take loan. More and more companies will take loan. Another way to increase money supply is you will purchase a lot of government securities from the market. Thereby, either you use tool 1, tool 2, etc. Thereby, what you do is you increase the money supply. You increase money supply in the market. Now, when you increase money supply, interest rates are lower, companies will take a lot of loans, right? Consumption will increase. Now, don't you think that will lead to a virtuous cycle in the economy? Just think of it. All of this will lead to a virtuous cycle in the economy. GDP will start increasing, employment numbers will start increasing, people will start consuming more and more goods and services. But there is a danger now. What is the danger? GDP starts increasing. Don't you think private sector now will start investing more and more automatically? I hope you understand. GDP is increasing, employment rate is high, demand is high, private sector anyways will start investing in the market. Now, do you think the same amount of money should be there in the market? During slowdown, you increase money supply. Now, demand is higher. Private sector is ready to invest. Should the same amount of money be there in the market? If the same amount of money is there, that will lead to inflation in the market. So now what will happen? Rather than easing means increasing money supply, you will go exactly opposite. That is, the central bank will follow opposite of quantitative easing. Opposite of quantitative easing is called as Fed tapering. Is it okay? Simple. Opposite of quantitative easing is called as Fed tapering. Now, what do you mean by Fed tapering here? Simple. The central banker in USA will start increasing interest rates. The central banker in USA will start increasing interest rates. Now, just now we have discussed this. If interest rate in USA will start increasing, is it okay if I say lot of money will start flowing from India to USA? Think of it. If the Federal Reserve will start increasing interest rate in USA, investors who are searching for better interest rate, they will basically take their money rather than investing in India in terms of rupees, they will take the dollars out of India, invest in US bonds. Because they are investing in dollar, they will earn in dollar rather than taking a risk and investing in rupees. So what will happen as a result of this? The rupee supply will increase. All of you will agree with this? That is, let's say you're a foreign investor who has investment in India. Federal Reserve in USA will increase interest rate. Now, rather than investing in India, you feel it is better to invest in USA. So what you will do? You will sell the shares of Indian companies. Your investments are there. You will sell them. Can you take out rupees? No, you will get rupees. You will convert rupees, sell them, and get dollars. Now have a look at this. As a result of this, can I say that supply of rupee in the Indian market increases, demand for dollar increases, and this will lead to rupee depreciation and dollar appreciation. So dollar will start flowing out of India, rupee will start depreciating in India. This is how the federal tapering that is happening in USA will have an impact on Indian rupee. Any difficulty in understanding this? Let me know. Right? Any difficulty in understanding this? Federal tapering happens in USA, but that will have an impact on Indian rupee. How? Indian rupee will start depreciating. Now, have a look at the next point here. Have a look at the next point. Don't you think if rupee starts depreciating, RBI should intervene? I hope you understand. If rupee starts depreciating, RBI should intervene and stabilize rupee. And if RBI wants to stabilize rupee, forex reserves are needed. And that is the main point here. The amount of forex reserves we have, RBI says, are more than sufficient to take care of any depreciation in rupee that will be caused by Fed tapering. I'll repeat it again. Process is very simple. In USA, imagine there is a recession. Central banker will reduce interest rate. Money supply increases. Now, there is a recovery in the economy. Federal Reserve cannot allow the same amount of money to continue to remain in the market. The Federal Reserve will increase the interest rate. Right? They will increase the interest rate to reduce money supply. Now, because the interest rates have increased in USA, the foreign investors who are there in India, they will withdraw their money, right? Sell their investment, convert rupees into dollars, take out the dollars from India. But in the process, Indian rupee will get depreciated. Right? So, Fed tapering in USA, should India be worried? Answer is yes. But is it a cause of concern? Right? Should we be worried so to a very great extent? No, we have sufficient forex reserve to address the depreciation in rupee. And I've told you, before the break, I've told you, when rupee will depreciate, demand for dollar will increase. What does RBI do? RBI will sell dollars, purchase rupees from the market, and thereby stabilizing exchange rate. So first factor that will have an impact on the exchange rate is interest rate. Second factor, incomes. Incomes of the people. Now think of this. If GDP of India increases, which means the people are earning more and more income, don't you think the demand for goods and services will increase? Now, when the demand for goods and services will increase, do you think all the goods and services will be manufactured in India? No, there will be a lot of imports that will flow into India. And when imports will come into India, will it not lead to outflow of dollars? And will this not have an impact on the exchange rate? At any problem in understanding the second factor, please do let me know. Second one, rising incomes, changing incomes. If incomes increase, demand increases, imports will increase, that will have an impact on rupee exchange rate. Third factor, inflation. Third factor, inflation. Understand this carefully. Imagine you are manufacturing this bottle in India. Okay, you are manufacturing this bottle and you are exporting it to USA. Now inflation increases in India. Inflation rate increases, which means the cost of raw material has increased, cost of transportation has increased. Now have a look at this. If raw material cost increases, labor cost increases, transportation cost increases, simple question to you people, what will happen to the price of the bottle? Think of it. What do you think will happen to price of the bottle? Increases. All of you agree? Increases. Now do you think if the price of the bottle increases, do you think your export competitiveness will increase or go down? Just think of it. Right? Don't worry about exchange rate. Just think of export competitiveness. If the price of the bottle goes up, what will happen to your export competitiveness? Your export competitiveness will go down. What will happen to your purchasing power of the currency? Purchasing power of the currency will go down. Don't you think that will have an impact on exchange rate? Your exports will go down. Rather than export, you might start importing it. Right? All of this will have an impact on the exchange rate. That is the reason, remember this. Just remember this. Generally, it is stated that any country which experiences a higher rate of inflation, right? I've written it, I'll underline it. Generally, any country that experiences not higher, lower rate of inflation, right, its currency in the domestic market will increase. That is, the purchasing power will increase, right? And as a result of this, right, it will have a better purchasing power. That is, a currency will have a better purchasing power in the international market, which means the currency value has increased. I hope you understand. Currency value has increased. It will start appreciating. The value of this currency has increased compared to other currencies because inflation rate is lower here. Purchasing power of this currency is always better or much better compared to another currency which has lost its purchasing power because of higher inflation rate. So is it okay if I say that between these two currencies, this currency has gained value, this currency has a lost value? Any difficulty in understanding this? Right, this currency which right, or in economy in which inflation rate is comparatively lower, purchasing power is much better compared to this currency. So don't you think this currency has got value, this currency has lost value, right? So very difficult to remember it. Don't worry, just remember it like this. Higher inflation rate, exports will be very less competitive. Rather, you might end up importing. Importing means what? Dollar is going out. Dollar is going out means domestic currency depreciates. Any difficulty? Higher inflation rate, depreciation. Very low inflation rate, appreciation. Shall I go to the next one? Right, any doubts, please let me know. First one is interest rates. Second one is income. Third one is inflation. Fourth one is a debt of the government. Right now, what is the logic? What is the connection? Whenever the debt of the government is high, it is generally associated with higher money supply in the economy. Please correct me if I am wrong. Ask me if there's a doubt. Whenever the debt of the government is high, simply means money supply in the economy is higher. Now you tell me, if the money supply is higher, what do you think will be the rate of inflation? Right? What do you think will be the rate of inflation? Inflation rate will be high. And inflation rate is low. How? How two of you say if the money supply is high, inflation rate is low? My dear, it simply means you have not even listened to what I've discussed in the last 2 weeks. Right? So when the money supply is higher, inflation rate is higher. Remember that. We have kept on discussing this again and again. If the debt is high, money supply high. If money supply is high, inflation rate is high. Now you tell me, if the inflation rate is high, will it not have an influence over the exchange rate? It will have an influence over the exchange rate. Right? So remember this particular point. So can you connect income with exchange rate? My dear, it's very simple. If the incomes are higher, right? Again, just follow the discussion. No, this is basics of economics. If income is higher, demand for goods and services is higher. If the demand for goods and services is higher, imports is also higher. And as a result of this, right, it will have an influence over the exchange rate. How debt is high and inflation is high? My dear, revise, no? It simply means you people are not revising. Please go back to inflation chapter, and you will see there is a chart that I've given. Inflation can happen because of the supply side factors, demand side factors. Under the demand side factors, I've written one factor, that is government expenditure. Government will borrow and spend a lot of money in the market, causing higher money supply. That is basically going to lead to inflation. Please revise. If you don't revise, everything is new for you. Next one, current account deficit. Give me some time, I'll come back to this. Right, higher current account deficit means rupee depreciation. I'll come to this, just give me some time, because I'm yet to cover balance of payment. We'll cover it in some time. Higher imports and higher exports, or variation in the exports and imports, will affect exchange rate. Next one, speculation. What do you mean by speculation here? Speculation simply means expected movement or expected event in the market. Remember this. The term speculation is very, very neutral. Neutral in the sense, you will come across speculation in inflation, you will come across speculation in exchange rate, you will come across speculation even, right, in short selling. Now just think of it and tell me first, understand the term speculation. Speculation simply means you are expecting something to happen. Expecting, right? There is no right evidence of it. You are expecting something to happen. Now, is it okay? Just think of this and answer. Is it okay if I say short selling involves speculation? Let me know. Short selling involves speculation. Is the statement correct or wrong? Let me know. Right, start answering. Last session, I know that. Participate. By participating, you will understand the concepts much better. In short selling, there is speculation. Correct. Statement is correct. Right, sir, why? Okay. My dear, short selling, right? Kya hota hai? What happens in a short selling? In short selling, you expect that market prices will go down. That's the only reason you are borrowing the securities. Are you not speculating a downward movement in the prices of the commodity or share? Right, there it is. So speculation means expectation that some event will happen. That is speculation. Now, how speculation is connected to exchange rate? How it is connected? Let me give a very simple example. Imagine, understand this. Imagine you are supposed to pay $1. Or, right, I'll give you one more example. Imagine you have, your friend is there in the USA. You want your friend, when he is coming back or she is coming back, you want your friend to bring iPhone into India. Just a simple example. iPhone, iPad, or any, let's say from Dubai, gold for that matter. Now, how speculation will play an important role here. Today, let's say, exchange rate is $1 is equal to 50 rupees. Let's say today exchange rate is $1 is equal to 50 rupees. Now, simple question. If Russia and Ukraine again start the war, right? Again start the war means right now it has, right, mellowed down a bit. Level of war, level of engagement is slightly on a lower level. Now, what if Russia uses a nuclear bomb on Ukraine? Just a simple example to make you understand. Now, don't you think the war will go to the next level? Now, you tell me, what will happen to exchange rate because of this? You tell me, right? After 2 or 3 days, what do you think will happen because of this in case of exchange rate in India? Don't you think rupee will start depreciating? I hope you understand. Don't you think rupee will start depreciating because of this? It should happen. You should be able to connect it. Now, right, Will you wait for rupee to depreciate from $1 is equal to 50 to let's say $1 is equal to let's say 70 and then convert the dollars and pay your friend, or today itself you'll go to the market and convert your rupee to dollar? Just think of it. If you're expecting that rupee will depreciate in the coming days, will you wait for it to depreciate and then convert the rupee to dollar, or today itself you will go to the market, convert the rupee to dollar? You will do the latter, right? You will do the latter because it makes a sense for you. But don't you think that's a speculation? I hope you understand. Don't you think what you did here is basically a speculation? You're expecting because of the events that are taking place, something might happen in the coming days. That's a speculation. What if exactly opposite happens? You're expecting or you're speculating that rupee will appreciate. Think of this. You're expecting that rupee will appreciate. Now, will you convert your rupees to dollars today or after a certain number of days? Just think of it. If rupee appreciates, will you convert your rupee to dollar today or after let's say 1 week? What does make sense to you? You'll basically postpone the conversion. You'll basically say after 1 week I'll convert it, because rupee appreciates, you will have to pay lesser rupees to purchase the same dollar. Now, this is the effect of speculation on exchange rate. Effect of speculation. You feel that tomorrow OPEC will come together. They will have a discussion and they will cut oil supply, which means oil will become very costly tomorrow. Don't you think today itself you will try to purchase more and more oil and make payment? Is the logic okay? Is the logic okay? Right? So argument is, in the market, speculation will also play an important role. As a result of this, there will be more sales of rupees and purchase of dollars, or the purchasing of dollars and sales of rupees will be postponed by some days. That is speculation having an impact on exchange rate. Government stability, policies and economic growth. Right? Best example, Sri Lanka, Pakistan. A simple question. Right? You keep Sri Lanka and Pakistan on one side, India on the other side. You're a foreign investor. You tell me, where will you invest? Think of it. Right? And it's very easy to understand also. On one side, we have Sri Lanka, and on the other side, we have India. You're a foreign investor. Where do you want to invest? You want to set up a company. You want to invest in stock market. Which market would you prefer? India. Now, why? If I ask you why, you'll simply understand, sir, Sri Lanka, Pakistan, no stability of the government. Government is not stable. And if you ask me, sir, how stability will have an impact? Very simple. If the government changes, policies will change. I hope you understand. If the government changes, policies will change. And if government is not stable, policies are not stable. Would you want to invest in a market where there are no stable policies? Your answer should be no, by the way. You should not think. You should not think. You should simply say, no, sir. So don't you think growth of a country, policy stability, stability of the government, etc., will either attract investment or push away the investment, prohibit or attract? If they attract, of course, impact on the exchange rate. If there is no stability, there could be outflow of investment, again the impact on the exchange rate. So either ways, that will have an impact on the exchange rate. Now, any of these factors you have a doubt, please do let me know. CAD, I have not yet covered. I will cover it in some time. Please give me time. I am only saying current account deficit I have not covered. I'll cover it. But what factors I have covered? Interest rate, right? Let's say income changes, inflation, the debt of the government, speculation, government stability, growth of the economy, imports and exports, etc. Speculation, I'll repeat it again. Speculation simply means expected movement in the market. You believe that there will be some change in the market. That is called as a speculation. Now, if you believe that rupee will depreciate tomorrow and you have a payment to make in terms of dollars, today itself you will go convert the rupee to dollar, thereby increasing the supply of rupee, leading to depreciation. Right? So that is the basic idea of speculation having an impact. Now let me ask you a very simple question. After having looked at all of this, I will tell you a statement. Please tell me whether the statement is correct or correct or wrong. Monetary policy of the Reserve Bank of India will have an influence over exchange rate in India. I'll repeat it again. Monetary policy of Reserve Bank of India will have an influence over exchange rate in India. Correct or wrong? Start answering. Only then I can come to know whether you are understanding or not. The statement is correct. Statement is correct, by the way. So how? My dear, first statement, right? The first factor which affects exchange rate, what is it? Interest rate. Now you tell me, will monetary policy have an impact on interest rates in India or not? I hope you understand this. Will the monetary policy in India have an impact on the exchange rate or not? Right? Yes, because it will have an influence on the interest rate. Interest rate will affect exchange rate. So answer is yes, by the way. Okay. So I've never used the term monetary policy in any of the slides here. Suddenly UPSC will write monetary policy, one of the factors affecting exchange rate. You'll keep on thinking, he never used monetary policy, idiot, he has not taught correctly, etc., etc., without realizing monetary policy will influence interest rate will influence exchange rate. Okay. Now, next is a nominal exchange rate, real exchange rate. But what I will do is, I'll skip it today. I'll skip it today. Right? There is a reason for it. Slightly technical. Third session, Sunday, many of you are already worried about economy. Now looking at the formula as well as the calculation for both of them, you will have a heart attack. So what I'll do, right? Please remember this. Next week, I'll discuss this. Saturday, I'll discuss this. Do not worry. I will not leave it to you. I'll discuss it. Right? Only thing is that there are calculations here. I don't want you to be worried about the calculation, and this is a third session. I'll skip it. That's the only reason. Now, don't worry, sir. You have skipped 4 to 5 slides. I'll cover all of them. Please don't worry. Have patience. Now, there was one more factor, current account deficit. Right? One of the factors that affected exchange rate was current account deficit. Let me discuss the current account. Right? What is a deficit? How it will influence exchange rate? Let's connect the dots here. Now let's start. There is something called as a balance of payments. BOP, balance of payments. Now what is this balance of payments? Simple. Whenever you talk about a country which is an open economy, there are a lot of transactions that will happen. That is, those are transactions that will lead to inflow of the dollar and transactions that will lead to outflow of dollars. Is the point okay with you? Open economy means what? Dollars will come into India because of multiple transactions. Dollars will flow out of India because of multiple transactions. Now, don't you think all these transactions should be recorded? I hope you understand this. Don't you think all of these transactions, you should keep a record of it? And who will keep the record of all of these transactions? Reserve Bank of India, RBI. Remember this. RBI will record. Record means what? Note down. Right? Simply publish. That's it. RBI will record all these transactions which will lead to inflow of the dollars as well as outflow of the dollars. And this record of transactions is referred to as balance of payments. BOP, balance of payments. I'll define it again. Follow this carefully. Balance of payments represents record of all the inflow transactions as well as outflow transactions. Right? Again, what do you mean by inflow transactions? Dollars bringing in, transactions bringing in dollar. Import transactions. Dollars which are taken outside India, export transactions. So all the import transactions, export transactions between India and rest of the world, it is called as balance of payments. Any problem with the definition? Please do let me know. Any problem with the definition? Can I go forward here? Now, whenever you talk about these kind of transactions, you can divide these transactions into two accounts. One is called as a current account. Second one is called as a capital account. Now, before I go forward, make a note of this. As per IMF, International Monetary Fund, I repeat, as per IMF, International Monetary Fund, there are not two accounts, rather there are three accounts. One is a current account, second one is a capital account, third one is a financial account. But in case of India, RBI publishes only two accounts. Because RBI is the authority here, RBI will publish only two accounts. What RBI does is financial account is clubbed into capital account. Is it okay? That the financial account is basically clubbed, right? Because traditionally there have been only two accounts, and we have continued the traditional concept in India. So one account is current account, second account is capital and financial account. But even in the RBI documents, they'll simply write it as capital account itself. Now, what is the basic difference between current and capital? Follow this carefully. Whenever you're talking about assets, right, that is basically creation of assets, transfer of assets or liabilities for that matter, those transactions will be recorded under the capital account. Right? Any difficulty, please do let me know. Whenever you talk about assets here, right, assets means what? Anything that will fetch you returns. So assets and liabilities, those transactions will be recorded in the capital account. And whenever you talk about revenue transactions, revenue nothing but income transactions, you will record all of those in the current account. Any difficulty, please do let me know. Whenever you are talking about revenue or income transactions, income transaction means what? The money that you are earning, the money that you are paying. These kind of transactions, it is recorded in the current account. And whenever it is a transaction related to asset and liability, it will be recorded in the capital account. Let me give you examples, you will understand it. You will export certain goods and services. Will you not earn income on it? You will record it under the current account. Imagine you will go to USA, you will earn a salary there, but you will send part of your salary to your spouse or let's say to your parents. Is it not income related transactions? It will be kept under the current account. But on the other hand, let me give you another example. ECB, tell me, external commercial borrowing. Where do you think external commercial borrowing will be classified? Current account or capital account? Just think of it. Apply logic, you will get the answer, right? Automatically. External commercial borrowing, current account or capital account? Capital account. Somebody says current account. My dear, what are you listening to? Right? Focus on the discussion. I said asset and liability, put it under capital. ECB, is it not a liability? You are borrowing. Is it not a liability? Where should you keep it then? Right? It's under the capital account. A foreign company will bring money into India, invest in the stock market. Where? Current account or capital account? Capital account. Right? A foreign company will bring money into India, Set up a manufacturing facility. Where will you keep it? Capital account. Is the logic clear now? Let me know. Is the logic clear? Once you understand this, even if anything is asked, you will write it easily. So whenever you are talking about assets and liabilities, right? Adding to the assets, reducing the assets, increasing the liabilities, reducing the liabilities, keep it under the capital account. And whenever you are talking about anything addition, right, to the income of a country, income, earnings of a country, keep it under the current account. Right? So current account, capital account. Now, within the current account, there are two sides. Same thing for the capital account. That is, those transactions that will lead to inflow of the currencies, we'll call this as a revenue transaction. And those transactions, right, which will lead to outflow of the currencies, we'll simply call this as, right, the expenditure transaction. Okay, you have revenue side, expenditure side. Revenue means inflow of currencies. Expenditure means outflow of currencies. Right? If you have a doubt, please look at the first one. Look at the first one, automatically you will understand. What is the first component under the revenue side, right, of, let's say, current account? And the first component under the expenditure side under the current account. Imports and exports. Now, when you export, will it not lead to inflow of currencies into India? Right? It simply means India is earning revenue side. If you import, is it not leading to outflow of currencies? India is paying expenditure. Is the logic okay? Is the logic okay? Don't be confused. It's all very simple. You need to understand it first time. Once you understand it, done and dusted. So first concept is very simple. Export and import under the income and expenditure. A second component, understand this carefully. Imagine you're a foreign investor. You're a foreign investor. You have invested in a government bond in India. I hope you understand. You're a foreign investor. You have invested in a government bond in India. Will you earn interest on this or not? Is it okay? Will you earn interest? I'm not talking about the bond here. Will you earn interest or not? You will earn interest. Right? That is first one. Second, you are a company in India. You have taken a loan from the external market. That is, let's say, external commercial borrowing. Please be careful here. You have taken a loan. Loan is classified under capital. But what about the interest that is paid on it? Interest that is paid is basically written under the current account. Is it okay? Loan is always a capital, but the interest that is earned, interest that is paid is always a part of current account. Right? So have a look at this. You have taken ECB, you will pay interest. Can I call this as a debt service payment? Is it okay? Right? I'll repeat it. You have taken an ECB or you have issued a masala bond. Right? You will pay interest on it. Can I call this as a debt service payment? Answer is yes. That is the second component. In the same way, imagine you have invested in, let's say, a bond of a foreign company, or there is an Indian company in India, right, or Indian institution which has invested outside India. Will they earn interest or not? Just like foreigners are earning in India, will Indian earns outside India? Answer is yes. So that is called as investment income. I hope you understand. Investment income, right? Basically counterpart. What you write this side, you'll have to write on the other side also. Remittances coming in, remittances going out. Right? Remittances coming in. Remittance means what? Transfer of money. Simple. Remittance is nothing but transfer of money. For example, people from India or workers from India will go to Middle East. They will earn money. They will send back it to India. All of you agree? You as a software engineer, if you go to USA, you will earn money. After 3 months, if you come back, will you not remit the amount back to India? Or if you stay there, will you not keep on sending certain amount of money to your parents? That is called as remittances. Remittances simply means transfer of money. That's it. Sir, why this is important? Remittances are crossing the border. I hope you understand. Remittances are crossing the border. So, right, one is in remittances, second one is out remittances. And please remember this, India is the largest country in terms of remittances. Remember this, very, very often this is asked in UPSC. Remittances are coming into India. Remittances are going out of India. Right? If you talk about net remittances, India has a positive net remittances. Any difficulty, please do let me know. Net means what? Remittances are coming into India, let's say $50 billion. Remittances are going out of India, let's say $20 billion. So what is the net outcome because of this? What is the total outcome because of this? $30 billion are coming into India. Right, sir, what is remittance? Again, I'll repeat it. Remittance means transfer of funds. Money is being transferred. That is called as a remittance. Right, so remittances coming in, remittances going out. India is the largest country in terms of receiving remittances. Please remember this. Right, we are expected to hit remittances worth $100 billion in 2022 as per World Bank report. So any doubts regarding the current account components? And this is not the only, these are not the only components. List is very, very long. List is very, very long. You do not have to by heart everything. This is a simplified version of balance of payment. Any problem with the first current account? Let me know. Any problem within the current account? Right, because I'll go to the next one, capital account. But before that, let me give you one more concept here. The current account, generally we divide into two parts, visibles and invisibles. Visibles and invisibles. Now, is there anyone in the student who says, sir, what do you mean by visible? Let me know. Anybody who is there here who says, so define visible. What do you mean by visible? Right, so understand this, the current account you can divide into two parts, visibles and invisibles. Why this is relevant? Visibles are nothing but goods or merchandise. Is it okay? Goods or merchandise are visibles. What about invisibles? Services. Services are invisibles. Remittances are invisibles. Income are invisibles. Any difficulty, please do let me know. Income is nothing but second component. Income is nothing but second component. Right? If I want to make it much more easier, just to make you understand, can I divide the exports and imports into two types? That is goods and services. And you can have the same division for both exports and imports. Now imagine I'll number them. 1, 2, 3 and 4. If I number them, what is visible? Number 1. Is it okay? What is visible part of the current account? 1. Which part is invisible in the current account? 2, 3 and 4. Any difficulty, please do let me know. Income is nothing but the second one, investment income, debt service payment, that is invisible. In remittances, out remittances, invisible. Right, services coming in, going out, invisible. Only the goods are visible. Shall I go to the next point? These are the kind of terminology UPSC might use in the examination. Please do not be confused. Now, next point, come to the current account. Right, how they are invisible. If you ask me how they are invisible, right, I don't know how to answer it. Can you see a service? Visibility means what? Is it visible or not visible? Now, if you ask me, sir, what is visible? Simple, my dear. Can you see the pen or not? Simple question. Pen is a product. Good, by the way. Can you see the bottle? Yes. Right? What do you mean by visibility? You can define the products based on the length, based on volume, based on the height, etc. That is visibility. If you ask me what is invisible, tell me software services. Can you see software services? Tourism services. Can you define tourism services in terms of length, height, etc.? That is a basic idea. Now, the concept of visibility and invisibility, that's basically the whole idea. Please don't be worried about that. Okay, come, right, focus on current account now. Focus on current account. I mean, investment income data will be recorded. Can we not take this as visible? It is recorded, but is the service visible? That is what I'm trying to tell you. Recorded, the number is visible. I'm not talking about that visibility. Is the product visible? Is the service visible? I'm talking about that. Right, so again, let's focus on the point of discussion here. Okay, now let me continue. Focus on the current account now. Focus on the current account. On one side we have exports, on the other we have imports, which means exports will bring dollars, imports will lead to outflow of dollars. First one, there is a term called as trade deficit. There is something called as trade deficit. Sir, why deficit? Generally, India has a deficit. That's a reason. Now, have a look at this. If the value of exports, is smaller than value of imports, is it okay? This is nothing but trade deficit. Any disagreement? Please do let me know. Trade means what? You're exporting, importing goods, you're exporting, importing services, etc. So what you can do is, you can take only goods and see what is the value of export of goods, what is the value of imports of goods. And when you talk about only goods by the way, the value of goods that we import is greater than value of the goods that we export. Meaning, if I export $10 billion worth of goods, I will import, let's say, $15 billion worth of goods. So don't you think this is a deficit? Extra $5 billion is flowing out of India, right? Deficit. Can we do the same thing for services? Of course, yes. But difference is very simple here. In case of services, we have export surplus. I'll repeat the statement. In case of goods, let me check whether I've given the data. Right? Have a look at this. In case of goods, and before I go forward, do not by heart the table. Do not by heart the table. Observe it. Observe it. There is a goods here, merchandise. Merchandise exports, merchandise imports. Now, what you generally see in the context of goods here, the value of imports is greater than value of exports, which means there is a net outflow of dollars from India. This is called as deficit. Is it okay? This is referred to as deficit. But on the other hand, if you focus on the services, the value of exports of services that we do compared to imports, value of exports is greater, which is nothing but surplus. Right? In the context of services, we enjoy a surplus. In the context of merchandise, we have a deficit. But what is the overall situation? If I talk about only exports and imports, what is the overall situation? Overall situation is deficit. Any difficulty, please do let me know. If I talk about overall exports and imports, right, as a result of this, whether the dollars are coming into India or dollars are going out of India, you will realize that dollars are going out of India. That is, we have overall a trade deficit. Can I go to the next point here? Any difficulty, please do let me know. There is an overall trade deficit in India. And certain important points to note here. What is the problem? Is having a trade deficit always bad? Absolutely no. Understand this. Having a trade deficit, is it always bad? Answer is no. Why? Whenever you import, you can divide the imports into essential and non-essential. Understand this? Whenever you will import either a good or a service, you can divide these into essential and non-essential. And how do you define what is essential and non-essential? Government of India uses this definition. Have a look at it. If for a particular good, there is sufficient capacity in the domestic market to produce it. Is it okay? A good is there. We have sufficient capacity in India to produce the good. But even then we import it. It is called as a non-essential import. Any difficulty, please do let me know. All these are important concepts. Right? How do you define what is non-essential? Sufficient domestic capacity is there. But even then, we import it. Can I give you example? Plastic toys. Plastic toys. Right? Or plastic electronics that we import from China. Right? Don't you think we have already sufficient amount of capacity to produce toys in India? But even then, we keep on importing these certain electronic components, certain low-level electronic components. Right, sir? Any example of a low-level electronic components? During festivals in India, take example Diwali. You people will end up purchasing. Again, when I say you, don't take it personally. Even I do that, by the way. We will end up purchasing electronic diyas. Right? Electronic diya. Right? Where do you think these are manufactured? Most of them are imported from China. Very, very cheap products imported from China. Right? So argument is, when we have sufficient domestic manufacturing capacity in India, even then we import it, it is non-essential. Any example of essential? Crude oil. Crude oil, best example of essential product. Do you think we have sufficient production capacity of crude oil in India? Absolutely no. The demand is so high compared to how much reserves we have. The gap is very, very high. And that is a precise reason we end up importing a lot of crude into India. Now, is the logic okay? Is the logic okay? Right? You can have multiple examples. Automobile components, right? Essential import. Activated pharmaceutical ingredients, API, essential imports. Right? So, there are certain imports which are essential. There are imports which are non-essential. Now, don't you think if the non-essential imports are increasing or on a higher level, that will contribute to trade deficit? Think of it. If non-essential imports, we continue to import them, will it not contribute to trade deficit? So now the question is having a trade deficit always bad? No, always it is not bad. But if your trade deficit is increasing, or you are having trade deficit because you are importing a lot of non-essential imports, then you need to reduce it. Then you simply need to reduce it. And trust me when I say this, Government of India is actually doing this. Government of India is actually doing it. For example, remember this, although you are going to write the exams next year in the mains, India very, very recently has become a net exporter of toys. I'll repeat the statement. And it's a good achievement for India. Indian economy very recently has become a net exporter of toys. Right? We are exporting more and more toys to the Western market or international market now. That is a good achievement. Right? So the argument is simple here. Imports are there. You will have to control non-essential imports so that you can reduce the trade deficit. That is point number 1. Can I go to the next point here? Can I go to the next point? Next point is simply the whole current account. The whole current account, full current account. Current account deficit, current account surplus. Now simple logic here. Generally in the context of India, we have a current account deficit. That's a reason very often in the newspaper you'll come across short form of this CAD, current account deficit. Now you'll ask me, sir, why? Why do we have current account deficit? Right, here is the culprit. I hope you understand. Trade deficit is a culprit, right? And is it the only culprit? Absolutely no. Right, if you basically look at it, right, have a look at the components here. If you look at it, trade deficit is basically first part of the current account, one of the components of the current account. Is it the only one which is contributing to the deficit? Absolutely no. In remittances, we are positive. Positive means net remittances are flowing into India. Trade deficit is there, contributes to current account deficit. And one more culprit is income. Right, one more culprit which contributes to a current account deficit is income. Income means on the investments, how much dollars are coming into India, it is much lower than how many dollars are going out of India. Foreign investors are earning interest in India. The outflow is much higher compared to inflow. This also contributes to current account deficit. Right, is the logic okay? Generally, India has a current account deficit, and the reason is one majorly trade deficit, and the second one is, right, a negative, right, income, negative net income. Negative net income means outflow of dollars is much higher compared to inflow of dollars. Both of them contribute majorly to the current account deficit. Now let me go to the third point here. Let me go to the third point. If you have a current account deficit, right, it will put a lot of pressure on the economy. Understand this. If you have a current account deficit, it will put a lot of pressure on the economy. Why? Current account deficit simply means there is a net outflow of dollars. Simple. CAD means there is a net outflow of dollars from India. Dollars are going out of India. Now, from where do you get these dollars? From where will you have these dollars from then? Don't you think you are not allowed to print dollars, which means you will have to have dollars? If there is an outflow, from where will you get these dollars? That is where I say having a current account deficit will put a lot of pressure on the finances in the Indian economy, especially on the RBI, Reserve Bank of India, because RBI needs to keep on supplying dollars in the market. I hope you understand this, right? Some of you might be thinking, sir, how is that possible? Imagine dollars which are coming into India is 10. Dollars which need to flow out of India is, let's say, 15. Now, don't you think there is a shortfall of $5 here? Simple. Don't you think there is a shortfall of $5? How do you think this extra $5 will come into the market, forex market? RBI will supply it. Simple. RBI will keep on supplying the dollars to ensure that there are sufficient dollars to take care of outflow of dollars. What if RBI doesn't do that? What if RBI doesn't do that? Don't you think Pakistan, it is the same situation now? Don't you think Sri Lanka, it is also the same situation? Think of this. If RBI doesn't supply dollars and take out the rupees, that is, if they supply dollars, they will have to purchase rupees on the other hand. If RBI doesn't do that, which means RBI doesn't have dollars. And if RBI doesn't have dollars, is it not the same situation which Pakistan is there right now? Is it not the same situation which Sri Lanka is facing? Which means the country is defaulting on the payment. Simple. The country is defaulting on the payments. They are not able to make dollar payments on the imports, right? Which Pakistan is doing right now. They have defaulted on the payment, which Sri Lanka has done earlier. So that's the reason. Remember this. having a current account deficit, right, up to certain level is okay. Because I hope you understand this. Imagine RBI has $100. The maximum number of dollars that are there with RBI is, let's say, $100. What if the current account deficit is $500? Tell me, how is that possible? How is it possible to take $100 and ensure $500 will be supplied in the market? So that's the reason, remember this, whenever there is a continuous current account deficit, and if the current account deficit keeps on increasing, it is a cause of concern. But before that, before coming to any conclusion here, generally in the context of India, please look at the table here. Please look at the table here. We have a current account deficit. No doubt we have a current account deficit. But one of the factors that works in favor of India, that will give an advantage to India, is in case of capital account, there is a surplus. Is it okay? I'll repeat it again. Right, in the context of India, the current account is deficit. CAD is a deficit. But what works in favor of India is, under the capital account, we have a surplus. Surplus means what? Under the capital account, the dollars which are flowing into India are higher compared to dollars flowing out of India. For example, right, the foreign direct investment, foreign institutional investors who are bringing dollars into India, right, external commercial borrowings, etc., etc., etc. Now, is it okay if I say we have a surplus here? Means extra dollars are there, or extra dollars are coming into India, and we can use this surplus to ensure current account deficit is addressed. I'll repeat it again, understand this. Right, the amount of dollars which we are getting under the current account, surplus dollars, is higher. It is more than sufficient to take care of the deficit that is there in the current account. Any problem with understanding this? Let me know. Any problem in understanding this? Now have a look at this and let me know whether can you connect the dots or not. Earlier in the afternoon session, I said external commercial borrowing was $750 million, and RBI, I said, for certain time period has increased this to $1.5 billion. Did I mention this or not? Now connect the dots. If RBI increases external commercial borrowings from $750 million to $1.5 billion, don't you think that will help in extra inflow of dollars into India now? I hope you understand. Will it help in extra inflow or more inflow of dollars into India now? And during pandemic, and this has happened, this is a fact, that's a reason RBI has actually doubled it. Right, during the pandemic, there was a huge impact on the forex reserves. Forex reserves were depleting. The current account deficit was actually widening. In the last 1 year itself, it was widening like this. Now, during the period where forex reserves are depleting, CAD is widening. Will the doubling of the limit of ECB, will it help in controlling CAD? Controlling in the sense, will it not lead to higher inflow of dollars which we can use to pay for deficit in the current account? Right, so this is how you connect the dots. Please be very, very careful. Please be very careful. Everything is connected in the economy. Right, why did they double it? So that dollars will flow more into the economy. Right, as a result of this, we will have more surplus under the capital account. More the surplus under the capital account means we have more dollars now to pay for the deficit in the current account. Right, that is the reason why Government of India liberalizes FDI. That is the reason why RBI doubled the limit under ECB, etc., etc., etc. Can I go to the next point here? Can I go to the next point? If there is any issue, please do let me know. Right? So these are certain very important aspects of a balance of payment. Now, let me connect one more dot here. current account deficit. Now you tell me, will it have an impact on exchange rate or not? Simple now. After all of this, it should not be very difficult for you. Will the current account deficit, will it have an impact on exchange rate? Answer is yes. That's the reason one of the factors influencing exchange rate was CAD. Right? One of the factors that was influencing exchange rate was current account deficit. Now that is also addressed. Let me go forward. Current account is over. Trade surplus, trade deficit. Right? Current account deficit, current account surplus. Surplus in capital account, that is generally observed in case of India, good for us. Right? It helps us if there is a surplus. Now finally, right, look at the full table. Look at full table, not just part of it. Look at the full table. There is a term called as BOP surplus, BOP deficit. Right? Let me check whether I've given the full table here. No, it is not there. Don't worry. Right? And that is not relevant for UPSC also. I taken a picture. I thought it was there. Don't worry. So full table, you look at it. The revenue side and expenditure side. The revenue as well as expenditure side. Now, is it okay if I say the total amount of revenue in the BOP, the total amount of revenue, if it is greater than the expenditure side, it is a BOP surplus. I'll repeat it again. The total amount of revenue, I'll add one more slide here. The total amount of revenue, if it is greater than the expenditure side, and what I'm saying is also very important. I'm not talking about only current account. I'm not talking only about capital account. I'm saying focus on full, current, capital, everything. If the revenue is greater than the expenditure, can I call this as a BOP surplus? Can I call this as BOP surplus? Now, next point. Next point, understand this. If there's a BOP surplus, what does it mean? More dollars have come into India. Any problem with this? If there is a BOP surplus, there are extra dollars compared to outflow. There are extra dollars which have flown into India or which have come into India. Now, if there are extra dollars in the market, don't you think that will be purchased away by RBI during the process? Right? If there are extra dollars in the market, don't you think RBI will simply purchase it away? And is it okay if I say, if there is a BOP surplus, you generally see forex reserves increasing? Let me know if you disagree with me. If there is a BOP surplus, you generally see an increasing forex reserves. Right? This is called as accretion. This is referred to as accretion. Accretion means addition. And what if it is vice versa? What if it is vice versa? Revenues is smaller than expenditure. Expenses are higher. Outflow of the dollars is higher. Now tell me, you bring in, let's say, $100, but you will have to pay $200 totally within the BOP. Right? Within BOP, current account, capital account, total. You bring in $100, but you will have to pay $200. From where do you think you will get this extra $100? These will come from forex reserves. Right? These will come from forex reserves. By the way, this is called as a BOP deficit. This is referred to as BOP deficit. This is called as a BOP surplus. Right? I've written the surplus already. Right? So BOP deficit, which means the dollars which are flowing out of India are more than dollars coming into India. So now question arises, from where do you get this extra $100? You will get it from forex reserves. Simply get it from forex reserves. RBI will supply. Now have a look at the next point. Because of this, can I say that RBI will sell, or RBI is the seller of official reserves? I hope you understand my statements here. I'm saying that the dollars which have come into India are lesser compared to dollars which are flowing out of India. Now the question arises, who will sell these extra $100? Who will supply these extra $100 in India? It is RBI. RBI sitting on the forex reserves. RBI will sell these in the market. Ensure that there are $200 in the market. This is called as sale of official reserves. Is it okay? This is referred to as sale of official reserves. And if UPSC will ask you who will conduct the sale of official reserves, Reserve Bank of India, RBI. Now next point. Let's say hypothetically, just take a simple example. Let's say hypothetically, you need extra $100. There's a deficit of 100. You need $100. But in the forex reserves, only $50 are there. Right? Understand the problem here. Right? In the reserve, $50 are there, but there is a deficit of $100. Do you think your reserves are sufficient to bridge the BOP deficit? Right? Have a look at this. Right? Do you think the amount of dollars that are there are sufficient, that is in the forex reserves, are sufficient to bridge the deficit? No. So whenever you arrive at a situation where you are going to deplete means finish off all the reserves, but even then you do not have sufficient money to pay off the debt, pay off to the external market, this is called as BOP crisis. I'll repeat it again. What is a BOP crisis? It's a situation wherein the forex reserves are depleted. Forex reserves are over. But even then there is a BOP deficit. That is called as BOP crisis. The last time India faced a BOP crisis was back in 1991. Remember this. The last time when the Indian economy faced a BOP crisis was back in 1991. After that, no. We have kept on increasing the amount of forex reserves. Even today, we hold more than $500 billion worth of forex reserves. One of the highest in the international market. We hold more than $500 billion worth of forex reserves. And these are very, very important. These are very, very important. Done? Any doubts? Can we go to the next point here? Any doubts regarding, right, what do you mean by BOP crisis, BOP deficit, BOP surplus, right, how forex reserves are important, etc., etc. So can we say Sri Lanka is facing BOP crisis? Of course, yes. Pakistan is facing crisis. Sri Lanka is facing crisis. That's the reason both Pakistan and Sri Lanka, they want to take loan from IMF. Simple. I have to understand. That's the reason why both Sri Lanka and Pakistan, they are negotiating with the IMF to borrow from IMF. Right? IMF will give them dollars. Very simple. What is FPI? Not today. FPI will cover it separately when I take up investments. There is a chapter called as investment models. FDI, FPI, etc., etc., etc. We will take it up later. Please don't worry. Right? How to handle BOP crisis in a country? I'm telling you, no. Right? Listen to what I'm saying. I gave you example of two countries which are facing BOP crisis. And what did I tell you? Both the countries are negotiating with IMF for a loan. That is generally what happens. Whenever the countries face the issue of BOP crisis, they approach an organization by the name of IMF. They will seek assistance from IMF, loans from IMF. And like I said, the last time that we faced BOP crisis was in 1991. Did we approach IMF? Answer is yes. We approached IMF, took assistance, loans from IMF. Okay. Now, this is a discussion regarding the concept of a BOP. Okay. Any difficulty? Please do let me know. Right. Any difficulty regarding the concept of BOP? Let me know right now. For closed economy, BOP does not matter? No. Right. For a closed economy, you're not conducting transactions with the rest of the world. If there is no export, there is no import. What is the importance of BOP there? Are you exporting something in a closed economy? No. Are you importing? No. Right? You are completely closed, shut off for the rest of the world. Right? So where is the requirement of dollars there? Okay. How RBI sells dollars? Did you not attend the earlier session where I told you how RBI will supply dollars or purchase dollars to stabilize rupee in the market? Right, I've discussed all of it. Okay, shall I go forward now? Any difficulty so far? Can I go forward? BOP surplus, BOP deficit, current account surplus, trade deficit, trade surplus, and surplus in capital account, deficit in capital account. Right? All these are important, needed for UPSC. Please remember this. BOP is surplus in case of India. Sometimes it is surplus, sometimes it is deficit. Okay. Now, if there is a deficit for a country, if there's a balance of payment deficit for a country, how do you address it? Right? How do you address it? One, you can promote exports, increase exports so that dollar inflow will increase. Second, reduce imports, reduce the value of imports so that outflow of dollar will come down. Third, you can target non-essential imports and reduce non-essential imports. You can do all of the above simultaneously. You can reduce overall imports. You can reduce specifically non-essential imports. You can promote more and more exports simultaneously. Encourage more and more inflow of FDI and FII. You can go for currency devaluation, but countries don't do this. I hope you understand. You can go for currency devaluation because what is the impact of currency devaluation? Simple. If you devalue your currency, your exports will become more competitive. I hope you understand. If you go for a currency devaluation, your exports will become more competitive. Don't you think inflow of dollars will increase because of it? And one more point, understand this very carefully. Right? Books will generally not discuss it. Understand this. If you go for a currency devaluation, can I say remittances will flow or more remittances will come into India? Think of it. Right? Just apply the logic, you'll understand why. If currency devaluation is done, exports will become competitive. That should be very clear to you. But in addition to this, you can also expect more and more remittances. That's very important. That is very important. Why? Imagine, right, there is an Indian who is sitting in USA, right? He also has relatives in India. He has investments in India. He has bank deposits in India. If $1 is equal to 50 rupees, now because of devaluation becomes $1 is equal to 60 rupees. Don't you think he will transfer more money into India so that his investments in India will increase? Right, so that is the reason. Now I hope you understand why Sri Lanka, why IMF will ask countries to devalue their currency. Is it okay? And the beauty of this is, right, especially this remittance part, beauty of this is it is one-sided. One-sided means goods and services, it's a two-sided transaction. You export, you earn. You import, you pay. Two-sided transactions. But what about remittances? What about remittances? These are simply one-sided transactions like this. That's the reason whenever a country faces issues like this, IMF will allow them to go for devaluation of the currency. Did we do devaluation back in 1991? Yes. In 1992, we actually went for devaluation of rupee. We have done it. But now we will not do it. Why? Because Indian economy is much more stable compared to what it was in 1991. Now some of you will ask, sir, why don't we do it? Let's go for devaluation. It will benefit us. Let's do that. The problem is simply this. You're not facing a crisis. Point one. You're not facing a crisis. What is the reason for devaluation then? Sir, it is a sovereignty. It is my decision. I will do that. Please go ahead, devalue your currency. Now, don't you think if you go ahead and devalue your currency, America will do the same thing? Right? America will do the same thing. Right? China is already alleged. Right? There is an allegation that China does it. Right? What will UK do? What will Germany do? What will other trading partners do? All of them will devalue their currency. So who is going to get the benefit of it? Nobody gets the benefit, right? Everybody is affected by the competitive devaluation like this. That is called as currency war. Remember the term. There's a term called as currency war. What is a currency war? When the trading partners will go for competitive devaluations. Let me know if you're not understanding this. If the trading partners will go for competitive devaluations, that is, you will devalue, I will also devalue. If I devalue, somebody else will devalue. Everybody, if they go for competitive devaluation, that is basically called as currency war. Right? Currency war. That is the basic idea here. Okay? So currency devaluation can promote your exports, can bring in dollars, etc. But stable countries don't do that. Right? Only the countries which are there in crisis, right, they go for devaluation. Okay. Long-term way out is always to promote exports. More and more exports. Long-term way out is always exports. Okay, so these are some of the measures, right? How do you address balance of payment deficit? But focus on this carefully. Forget about the heading. Forget about the heading. Look at the parameters very carefully. Except this. Don't you think Government of India is doing all the others? Think of this. Right? Forget about the heading. Don't worry about the heading. And if you look at all the parameters except the last but one, because you can't go for devaluation. Devaluation is done by countries which follow fixed exchange rate. Do you follow fixed exchange rate? No, you are following a floating exchange rate. You can't do that. Except that, don't you think Government of India is doing all of them? First, is Government of India promoting exports? I'll give you n number of examples. Make in India. Production linked incentive. What are these? These are to promote exports only. Second, decreasing imports and focus on decreasing non-essential imports. I'll give an example. Right? In the context of toys itself, focus on toys. In the context of toys itself, Government of India imposed certain restrictions on imports. That is, certain standards were made compulsory. What do you mean by standards were made compulsory? You want to import toys into India, get certificate first. Go to an authority, submit your products, get a certificate that these are of good quality. Only then we will allow you to import. Right, so non-essential imports, we have controlled it. We have controlled. You can take examples and you can write. Right, doing all of them simultaneously, of course, yes. Encouraging more FDI and FII, yes. Right, we have allowed in most of the sectors. Maybe next week we will come across this. In most of the sectors, we have allowed, right, inflow of FDI now. Right, very easy inflow of FDI. Not today. I'll discuss it later. Don't worry. Right, I'll have a detailed discussion on both FDI and FII later. And we are promoting exports as well. Right, so these are certain very important points. Please remember this. Please remember this. Sir, why these are important? What if UPSC will ask you, discuss the reforms that are being undertaken by the government to address the issue of trade deficit, to address the issue of balance of payment deficit. You will have to write current affairs examples. You cannot simply write hypothetically assume this, hypothetically assume that. That will not work out in the exam. Okay, so this is the concept of balance of payment. Now, anything is a doubt for you so far, please do let me know. Otherwise, we'll take a very short break, last break for the day. After that, finally 8 o'clock, full very big break. Third point, Government of India struggling to lower it. I did not say that there is no struggle. Of course, there is a struggle. But I say Government of India is doing it. Right? Any doubt so far? Any doubts so far? Doesn't devaluation lead to lower purchasing power? My dear, your objective for devaluation is protect your economy. Forget about purchasing power. Understand the reason why devaluation is done by countries. They are in crisis. When they are in crisis, should you be worried about purchasing power or protecting your economy? Right? What is your goal? Focus on that first in crisis. Okay, any doubts? Any doubts regarding what we have discussed so far? Sir, what is the question? My question was, discuss the measures that are taken by the government in order to address trade deficit. That could be one. Discuss the measures which are taken by the government to control the balance of payment deficit. Based on the requirement, you write the answer. Okay, done then. So let's take a small break. Right, let's take a small break. 7:1. I'll restart at 7:06. 5 minutes. I'll restart at 7:06 p.m. by the way, not a.m. 7:06 p.m. Okay. Good evening, everyone. Welcome back. Am I audible? Am I audible? Please do let me know. Okay, great. Let's start. So the last 50 minutes now, please be very careful. Focus on the discussion because again, we'll be discussing a lot of important concepts even now. Now, let me go to the next concept here, the idea of convertibility or the concept of convertibility. Now, what do you mean by convertibility? Let me start with the definition. Convertibility simply means how easily you are allowed to convert the domestic currency into foreign currency and back from the foreign currency to domestic currency. Understand my statement here? What do you mean by convertibility? In the market, whether it is very easy for you to convert rupee to dollar, dollar to rupee. Again, sir, why only dollar? Can we take any currency? Of course, yes. But because most of the transactions happen in dollar, we will take always dollar in the context. So I'll repeat it again. What is convertibility? How easily are you allowed to convert your rupee to a foreign currency and foreign currency into, let's say, rupee? Is it easy or difficult? Difficult because are there any restrictions? Are there any restrictions over the conversion? Is Government of India or RBI imposing any restriction on converting rupee to dollar, dollar to rupee, or no restriction, easily you can convert? That is called as a convertibility. Any difficulty now? Definition of convertibility. Any difficulty, right? Easily or difficult to convert one currency into another, right? And vice versa. Now, the concept of convertibility, I'll discuss under two concepts here. Current account convertibility, capital account convertibility. And what is this idea of a current account convertibility and capital account convertibility? Current account convertibility means within the current account, are you allowed to convert your rupees to dollar, dollar to rupees with restriction or without restriction? Is it okay? Within the current account, right, there are multiple transactions. You can export, you can import, etc., etc. So whenever you want to convert rupee to dollar, dollar to rupee within the current account, are there restrictions over conversion or easily you can convert without any conditions, without any restrictions? Right now, remember this, we say current account is fully convertible. I've written it here. Current account, it is fully convertible. Now, what do you mean by fully convertible? Simple. Imagine you have exported certain goods. You have received dollars. No condition on any of these conversions. That is, you can simply sell dollars, convert it into rupees. No conditions, no restriction whatsoever. That is the meaning of full convertibility. Now, let me give you an example of a restriction so that you understand it. You want to borrow from external market. Imagine this. You want to borrow from external market. Is there a tool for us? Yes, there is a tool. External commercial borrowing. There's a tool by the name of external commercial borrowing. A simple question to you. If you borrow under the ECB, is it part of the capital account or not? Let's go step by step. If you borrow under ECB, is it part of the capital account? Yes. Point number one, yes. Second, is there a limitation on how much you are allowed to borrow under ECB? Think of it. Is there a limitation on how much money you are allowed to borrow under ECB? Answer is again yes. Can I call this as restriction? Can I call this as a restriction? So understand the logic here. Whenever there are restrictions imposed on you to convert currency from the domestic to a foreign, foreign to domestic, we'll simply refer to this as non-convertible or partially convertible. I hope you understand. Non-convertible. Non-convertible means what? RBI or Government of India will never allow you to convert rupee into dollar or dollar into rupee. Is that the situation in India? Think of it. Is that the situation in India? Right? No. Of course no. Right? Are you allowed to borrow? Answer is yes. But there is a limitation on it. Should we call this as completely non-convertible? No, this is called as partially convertible. Is it okay? Right? This is referred to as partially. Partially means up to certain extent conversion from rupee to dollar or dollar to rupee will be allowed. Beyond the limit, there will not be any allowed conversions. I'll give you one more example connected to current affairs. There is a tool called as liberalized remittances scheme. Liberalized remittances scheme, LRS, liberalized remittances scheme. Now, right, what is the use of the liberalized remittances scheme? I'll start using short form here, LRS. LRS, okay. What is this liberalized remittances scheme? Imagine you have lot of money. You're an investor. You have lot of money. You want to invest in the USA stock market. I hope you understand. You want to invest in the USA stock market. Now, can you simply take your money outside India without any approvals? Just think of it, right? Because you are not taking out rupees. You might simply say, sir, I have earned it. I want to invest in USA, so nobody should stop me. RBI says, wait, thamba, wait. Why? You are not taking out rupees out of India. You are converting rupees into dollars. So when you convert rupees to dollars, I should be there in the system. I should be present in the transaction because you are taking out dollars from India. That's the reason. Have a look at this. Whenever you want to invest outside India, I repeat, whenever you want to invest outside India, up to $2.5 lakh per annum. I'm going to the definition again here. Whenever you want to invest outside India, you want to spend outside India up to $2.5 lakh per annum, you do not need any approval from RBI. No approval is required. No permission is required. Right? You want to go to trip. You want to convert rupees into dollar and you want to take out $50,000. Take it out. No problem. Take it out. You want to invest in the US bonds. Right? That is USA market. Bonds are there. You want to purchase the bonds of Tesla. You want to purchase the shares of Tesla. You want to purchase the shares of Alphabet. That is Google. Up to $2.5 lakh per year, do it. You don't require my permission. But the moment you cross the limit of $2.5 lakh per annum, you will require the permission of Reserve Bank of India. Right? So is it okay? Is it okay again if I say RBI is not stopping the conversion here? RBI is not saying don't convert rupee to dollar for any reason. RBI says up to certain limit, do it. But after the limit, I will impose restrictions. Right? I will impose certain systems in place that will make it slightly difficult to convert rupee to dollar, dollar to rupee. Right? This is called as partial convertibility. This is referred to as partial convertibility. Any difficulty in understanding what is partial, what is full convertibility? Please do let me know. Now, what is the inference? Within the balance of payment, current account is fully convertible. I'll repeat it again. Within the balance of payments, current account is fully convertible. Capital account is partially convertible. I'll give you one more example to prove the partial convertibility. Right? Just think of this and let me know. Think of it. Think of it. Should the foreign investors, when they invest in the government bonds, Should there be limitation or not? I hope you understand this. Right? When the foreign investors are investing and purchasing government bonds, that's very important. Government bonds. Should there be a limitation on the investment or not? There should be. I hope you understand. There should be a limitation on it. Sir, why? Why should we have limitation? For a very simple reason. Today they will come to India, purchase a lot of government bonds. Imagine no limitation is there. They will purchase huge amount of bond, and they want to do that, by the way. They will purchase huge amount of government bonds. Now, who is going to stop them if there's a crisis from selling all these bonds and moving out of India? Can you imagine the impact on the forex market because of that? Can you imagine the impact in the bond market because of that? If all these investors will simply sell, dump means sell it off, simply dump all these government bonds, what will be the value of government bonds in the market? Right? Basically, it will create volatility, right, in the bond market as well as forex market. That's a reason whenever foreign investors want to invest in the debt market, underline the term debt market, there are conditions. There are limitations on it. Again, concept is same, partial convertibility. So under the current account, full convertibility currently. Under the capital account, partial convertibility. In fact, remember the name of the committee. There is a committee by the name of Tarapore Committee. SS Tarapore Committee. The Tarapore Committee recommended that we should have full capital account convertibility. Remember the name of the committee. I repeat, there is a committee by the name of SS Tarapore Committee. The SS Tarapore Committee recommended that we should have full capital account convertibility, right? Capital account should be fully convertible. Now that is one point. Come to, right, another very important point under the current account. I have written a term called as LERMS. There's a term called as LERMS. Right, so have a look at this. Initially means 90-93. Till 90-93, we did not have full convertibility under the current account. We had, right, partial convertibility. What is this partial convertibility? There was a system which was introduced by government by the name of LERMS, Liberalized Exchange Rate Management System. Liberalized exchange rate management system. Okay, LERMS, very famous. It was introduced somewhere around 1992, was withdrawn somewhere around 1993. LERMS. Now what is this LERMS? LERMS is also referred to as double exchange rate. You'll understand in a minute, just give me some time. It is also referred to as a double exchange rate or double exchange rate system or dual exchange rate system. Rather than double, they will use the term dual exchange rate system. Now what do you mean by this? Follow this carefully. Under the LERMS, what government said was, imagine you have exported and you have earned a certain amount of dollars. Follow this carefully. Imagine you have exported and you have earned a certain amount of dollars. Now, how these dollars will be converted into rupees? How these will be converted into rupees? Because you need to convert dollar into rupees. You need rupees to spend in India. The government of India said there will be two exchange rates. Look at the term there. There will be two exchange rates. What is this two exchange rates? One, 40% of it, and the numbers were fixed, 40% and 60%. 40% of these currencies will be converted as per notified exchange rate. Notified means government will fix the exchange rate. Notified exchange rate. And remaining 60% will be converted into rupees based on market exchange rate. Market exchange rate. Done? Any doubts? Please do let me know regarding this. First, I said in the current account, today we have full convertibility. But earlier we did not have full convertibility in the current account. We had partial convertibility. Example, liberalized exchange rate management system, LERMS. And under this liberalized exchange rate management system, which is also referred to as dual exchange rate system, the government of India had installed a system in a place wherein any conversion of currency like this will be done at two exchange rates. 40% of it will be converted based on notified exchange rate, again notified by the government, and remaining 60% of these currencies will be converted based on market determined exchange rate. Right? Because two exchange rates were used here, the system is also referred to as dual exchange rate system. And this was withdrawn by the government post 93-94. This was withdrawn by the government, and we have implemented full convertibility under the current account, not capital account. Full convertibility under the current account has been introduced after the withdrawal of liberalized exchange rate management system. Any difficulty? Please do let me know. Right? Any difficulty regarding the concept of full, partial, etc., please, right, let me know now. Right? Why full convertibility? My dear, that will help us in attracting a lot of investments in India. Simple. Right now, there are a lot of restrictions as a result of this. Generally, amount of capital flows into India are capped. Capped means limited. Now you want to open up the market, you want to attract a lot of investments. That is generally why we say we should have full capital account convertibility. But there are concerns regarding that. Concern is what? If in case of a recession in Indian economy, foreign investors will move out of India, the amount of volatility they would be creating will be very, very high. I hope you understand. Right now there is a limitation. So volatility is created, we can control it. But full capital account convertibility means no restrictions. Huge amount of investments will come. But what about the flip side? If they move out of India, what about the flip side of it? That will have a huge impact. That is the reason, being concerned about volatility, even today we have partial convertibility in the context of capital account. Okay? Can you repeat why should there be limit on foreign investors? Just now I've told you the same thing. Example of current account convertibility. For example, if you have imported, exported today, there are no restrictions. There are no restrictions. You can basically convert without any restrictions, rupee to dollar, dollar to rupee. Lumps about import, generally this was applicable to the export earnings, because the dollars are very, very essential for us. Understand the logic here. Dollars are very, very important for us. That's the reason the restrictions were there. Okay, done. So this is a concept of convertibility. Okay, concept of convertibility, right? Is it fully convertible? For current account, yes. For capital account, no. Capital account, partially convertible. But remember the name of the committee, Tarapura committee has recommended full convertibility even in the capital account. Okay, now next concept, foreign trade policy, FTP 2015-2020. Foreign trade policy, FTP 2015-2020. Now some of you will be looking at it and saying, sir, we are in the year 2023. Why are you explaining older foreign trade policy? Point number one. Whenever foreign trade policy is announced, it is announced for a duration of 5 years. Is it okay? It is announced for a duration of 5 years. So earlier, foreign trade policy was announced from 2015 to 2020. A simple question to you people. What happened in 2020? Think, just think. right? What do you think has happened in 2020, right? COVID, pandemic, etc. So because of that, what government of India did was, rather than announcing a new foreign trade policy, they should have announced it. But because there was so much of uncertainty, volatility in the market, government of India said, let's not announce a new foreign trade policy. Let's extend the period of current foreign trade policy. Let's extend the period of application of foreign trade policy. So even today, as I'm speaking, even today, the old foreign trade policy is applicable. That's a reason in the beginning itself I've told you, keep your eyes open. You will get a new foreign trade policy very soon. It is expected that by 1st of April, there will be new foreign trade policy. Sir, why specifically 1st of April? Please look at the date, you will understand. New financial year will start. We want a new trade policy by the time a new financial year will start. Now, what are the provisions of existing foreign trade policy? What are the provisions? Let's go one by one. First one, earlier there are multiple schemes to promote exports of merchandise, that is goods, as well as multiple schemes to promote export of services. What government of India has done is, they have taken all these schemes, merged into one. So under the FTP, we have one scheme to promote merchandise exports, which is called as a Merchandise Exports from India scheme, MEIS. Second, the service export schemes, all of them were brought under one head. Only one scheme was implemented, Service Exports from India scheme, MEIS and SEIS. Do we have these MEIS and SEIS even today? Answer is no. Why? You will understand in some time, most probably next week, not this week. Don't worry, I will tell you. Both of these schemes, that is SEIS has been suspended by the government, MEIS has been withdrawn by the government. And remember this, in order to promote the export merchandises, in order to promote exports of merchandises, today we have RODTEP. Important, remember this, I'll come to this. Remission of duties and taxes on export products, RODTEP. Now next, whenever you wanted to export either goods or services under MEIS and SEIS, what was the incentive, right? How did government promote export of merchandise or services here? Government of India used to provide incentives. Understand this. Government used to provide incentives. What do you mean by incentives? Subsidy. In simple terms, subsidy. Incentives were provided to promote more and more exports of the goods as well as services. Now, how the incentives were provided? By issuing duty credit scrips. Now, before you start typing, sir, scrip, scrip is nothing but a certificate. Simple. What is a scrip? Scrip is nothing but a certificate. Now, you will ask me, sir, what do you mean by a duty credit scrip? What is the use of this certificate? Let's start. For the last time in the day, your friend is here now. Right? From today morning, it has been very helpful. Another time. Now follow this carefully. Follow this carefully. Imagine you have manufactured this bottle and I want, as a government, I want you to export this bottle more and more. Now I hope you understand why government will promote exports. That question should not be there. So government wants you to export this bottle more and more. Sir, only bottle? No. Let's say pen, marker or stylus for that matter. Let's say any other product or service for that matter. But how do you promote these exports? Government said, just take a hypothetical number here. Imagine value of this is, let's say, 100 rupees. Let's say 100 rupees. Government said, if you export 100 rupee worth of a product, 5% of it. I repeat, 5% of that value I will give it in the form of incentive. That is, I will issue a certificate to you. What will be the value of this certificate? 5% of 100 rupees, that is simply nothing but 5 rupees. Is the logic okay? Point number one. Is it okay? So imagine you have exported 100 rupee worth of good. Government will give you 5% of it. That is 5 rupees. Now this certificate, piece of paper, I will give it to you. And what is the value of this piece of paper? Value of this certificate is 5 rupees. Any difficulty in point number one? Let me know. Any difficulty in point number one? Hardly 20 more minutes are left out. Focus on the discussion. Any difficulty in point number one? Nobody wants to answer. Great. Right, let me go to the second point then. Right, again, participate. Another 20 minutes are there. Have patience. Now, point number two. Now, you will tell me, sir, great. You will give me a piece of paper, that is a certificate or duty credit scrip, which value is 5 rupees. What do I do with this? What do I do with this 5 rupee certificate? I will tell you. Tomorrow, if you import something, where you will have to pay certain taxes to me. I hope you understand. Tomorrow, if you import something, you will have to pay duties. Import duties have to be paid. Now, imagine you are supposed to pay 10 rupees. Out of that 10 rupee, 5 rupee you can pay it using this certificate. Is it okay? Tomorrow, if you are importing something and you are supposed to pay taxes to the government, 5 rupees you don't have to pay because the certificate is there. Give that certificate to me. I will consider this as a 5 rupee that you have paid. This was the utility. This was the use of duty credit scrip. If I were to give you a very simple example, you must have received certain vouchers in the shopping complexes, or you must have heard of various types of the vouchers which are issued by companies. Right, same application, apply the same thing. Right, so basically the scripts were issued, and if you are importing something, you can pay the taxes using the voucher or using the scrip. Point number two. Now, third point, some of you will find a problem in that also. What is your problem? You say, sir, I have received a script like this. Value is 5 rupees. But what if I'm not importing anything? Very valid, by the way. Right? Your argument is, what if I'm not importing anything? Then what do I do with this certificate then? Government says, don't worry. Even if you don't import anything, you can sell it to somebody else in the market. I hope you understand. Right? Even if you're not importing anything, you don't have use of the certificate or the script, don't worry. Transfer it, sell it to somebody else and get the money from them. Is it okay? Tradability or transferability. Scripts are transferable. Right? That is a very important point here. Why? The concept of transferability was introduced under foreign trade policy. Then we introduced one more reform, GST, Goods and Services Tax. And as per the GST Council, whenever the scripts are transferred like this, they will attract GST. Understand the problem here? Right? Whenever the scripts are transferred like this, they would attract GST. How much? 12% GST. Now, simple question to you. Government has issued a script. You are not using it. You want to transfer it, but GST is imposed on it. Don't you think that will create problems for you? Just think of it. Don't you think that will create problems for you? And by the way, answer is yes. Right? Because if it attracts GST, then the person who is purchasing it, they will have to pay more money. Why will they purchase the script from you? That is the precise reason. Have a look at this. Initially, GST rate was applicable. Later, right, the GST rate was reduced to 0%. Right, remember that point. And next point, whenever the scrip is issued, or let me ask you a very simple question. Imagine you get a voucher, and from anybody, don't worry. Domino has given a voucher to you, or Pizza Hut has given a voucher to you, or right, let's say Max Shopping right Center has given a voucher to you. Don't you think there is a validity period for the voucher? I hope you understand. Don't you think these vouchers will have validity period? Apply the same logic to scrip. Government has issued a scrip to you. Government said the validity period, that is right, you will have to use the scrip in next 18 months. So what if I don't use the scrip? Government says bad luck. This scrip is useless now. The validity has expired. You cannot use the scrip. Now initially it was 18 months. Now it has increased to 24 months. So right now if a scrip is issued under FTP, what is the validity of it? 24 months. Next, new logistics division has been set up. I'll not cover this today. Have a look at this. I will cover this when I take up infrastructure. I'll discuss road infrastructure and I'll tell you what is the use of the logistics division under the Ministry of Commerce. Now this is one more very important reform. Next one, e-wallet for the exporters was introduced. Now what is this e-wallet? Follow this carefully. What is this concept of e-wallet? E stands for electronic wallet. Simple. E stands for electronic wallet. Now, let's take a simple example and understand this. Imagine here is an exporter. Okay, imagine here is an exporter. This exporter will purchase goods, and when the exporter will purchase the goods, will the exporter pay GST? I hope you understand. Will the exporter will in any of the stages, will there be a payment of GST? Answer is yes. But the speciality about the GST is that, I hope you remember this, there is input tax credit that is provided. Right? Imagine they are manufacturing something. I am an exporter. I will purchase, let's say, plastic to manufacture the bottle. Have I paid GST? Answer is yes, by the way. When I purchase plastic, I've paid GST. I will get this as input tax credit. But the problem is, what if the government will take 30 days to provide me input tax credit? Right? What if government will take 30 days? Don't you think that will put a lot of pressure on me? Pressure in the sense, let's say, on the plastic that I've purchased, I've paid a GST of 10 rupee. And now the government will take 30 days to return that 10 rupees to me, which means for the next 30 days, I cannot use the 10 rupee. Now, what if I purchase another set of plastic? Right? Already 10 rupees is stuck up with the government. I am purchasing, right, once more plastic in the market because I need it. I need to manufacture the bottle and export it. Now, don't you think another 10 rupee will get stuck up here? Right? I hope you can see the problem. I hope you can see the problem here. So, Government of India realized that exporters who are supposed to receive input tax credit on some of the raw material or on some of the products that they have purchased, right, they should be provided relief here. Because in the first step, 10 rupees stuck up. In another step, another 10 rupees stuck up, which means my working capital is stuck up with the government. Any difficulty in understanding this? I hope you understand this. Right? The working capital, the precious working capital is stuck up with the government. Right? So don't you think that will put a lot of pressure on the exporters? Now, in order to provide relief to the exporters, government has introduced e-wallet, electronic wallet. Now, what is this electronic wallet? Simple. The exporter, like let's say me, I will purchase the plastic. I will submit the documents to government. And what they will do is, they will simply transfer certain amount of credit into my account. I'll repeat it. I'll repeat it again. I have purchased the plastic. I'm manufacturing the bottle. Now, Government of India, without having to go through all my documents, etc., then providing me the input tax credit based on my past documentation, based on what was done in the last year, how much credit I got last year, certain amount of credit will be transferred to me. Now, what is the use of this? Right? The use of this is simple. Imagine Government of India has transferred 20 rupees into my account. Right? It has transferred 20 rupees. Government says I can use this 20 rupees to pay GST whenever I purchase other goods in the market. Is it okay? Right? Government of India will simply transfer certain amount into my account. Again, when I say account, do not imagine bank account. That is, the exporters are having an account with one authority called as a DGFT, Director General for Foreign Trade, right? And the Government of India will simply transfer this notional credit. Technically, this is called as notional credit, because even government doesn't know how much exactly they're supposed to pay you. It will take, let's say, 30 days. But till then, what should you do? What should you do? Right, so government says, I will transfer notional credit into your account that you have with the DGFT, and now you want to pay any taxes to government such as GST, you can use the amount from this credit. This is called as concept of e-wallet. Can I go to the next one? Can I go to the next point under the FTP? Next one, interest equalization scheme. The last point for the day. Understand this. After this, we'll stop. Don't worry. Interest equalization scheme. IES. Interest equalization scheme. Now, what is this interest equalization scheme? Let me explain this. After this, we'll take a pause. Right? After this discussion, we'll stop the discussion. Don't worry. Now, what is this interest equalization scheme? Let's start. It's somewhere here only. PLI is there. RODTEP. And I guess it's here. Okay, done. Right, interest equalization scheme. Exporter, how can transfer GST to consumer? My dear, you should not export taxes. I hope you understand. You should not export taxes. That is, if you're exporting a product, whatever GST you have paid, government will give it back to you. Otherwise, you will transfer the taxes to a consumer who is sitting outside India. And that means you're exporting taxes. Exporting taxes means a product is less competitive. You should not export taxes. Come to the point here. What is this interest equalization scheme? Simple concept. Let's go step by step. Now, let me take a simple example here. Imagine you are an exporter. Right? Exporter means you are basically manufacturing a product and then you are exporting the product. Okay, now that's point number one. Point number two, when you want to manufacture the product, you will take a loan from a bank. You will take loan from a bank. Anybody has a problem with this? Exporters generally take loan. Now, when you take loan from a bank, will you pay interest on this or not? Are you going to pay interest on this? Of course, yes. You're supposed to pay interest. Now, follow the next point carefully. This is happening, let's say, in India. Imagine this is happening in India. Now, concurrently, simultaneously, imagine one more situation, let's say in China. Again, sir, why specifically China? Competitor, that's a reason. In China also, there is a manufacturer who is manufacturing the same product. He is also manufacturing same bottle. He will also take a loan from a bank. He will also take a loan from a bank. And that manufacturer will also pay interest to the bank. Sir, why are you writing all of this? Now look at this. What if the loan that is given by a bank to you in India charges 9% rate of interest, and the loan that is given by the bank in China to a Chinese manufacturer charges 5% rate of interest. Don't worry about rest of the things. Focus only on the rate of interest here. So you are manufacturing this bottle in India, you are paying 9% rate of interest, right? Your competitor is manufacturing in China, the competitor pays 5% rate of interest. Now, can I say that your competitor already has an advantage over you? Is it okay? Think of this. Last concept for the day, right? Focus. Is it okay? Based on only this information, I say that your competitor already has an edge, advantage over you. Right? Why? The competitor is able to get the loan at a lower rate of interest compared to you. Right? Forget about the technology, forget about labor cost. I'm not even talking about it. I'm talking only about why the Indian manufacturers are at a disadvantage compared to their competitors. Right? Best example is they are able to get, let's say, loans at a lower rate of interest. What if in addition to this, cost of transportation is lower in China, which is correct by the way. Cost of logistics in China is somewhere around 6%. India, 14%. Technology that they're using is much better to India. So as a result of this, don't you think you are at a disadvantage? Manufacturer in China is at an advantage. Now, in order to address this one component, in order to address the fact that you are getting loan at a higher rate of interest of, let's say, 9%, what if Government of India says part of the rate of interest, part, not complete, part of the rate of interest, Government of India will pay to the bank. Is it okay? I'll repeat it again. Part of the rate of interest, Government of India will pay to the bank. Let's say hypothetically, out of 9%, imagine 4% rate of interest. That is, if I take a number here, imagine loan value is 100. So 9% will be how much? 9 rupee interest. So out of that, government says 4 rupee I will pay, remaining 5 rupee let the manufacturer pay. Right? What is the advantage here? Advantage is the cost of loan, that is the loan rate of interest burden on the manufacturer automatically comes down. And when the rate of interest on the loan, which is effectively paid by the manufacturer, goes down, is it okay if I say cost of manufacturing will go down? And if the cost of the manufacturing will go down, right, don't you think it will promote more and more exports from India? Is it okay? Right? Will it not promote more and more exports from India? Competitiveness of Indian exports is promoted. This scheme is called as interest equalization scheme. The name of the scheme is interest equalization scheme. So IES was introduced as a part of 2015-2020. Very recently, RBI has announced that it will be extended till financial year 24. Remember this, right? Till financial year 24, it has been extended now. The exporters will be provided with interest subsidy. What do you mean by interest subsidy? Part of the interest will be paid by the government, remaining will be paid by the manufacturer. Now, who is eligible for it? Can everybody get access to this? What do you think? Right? Forget about the fact. Think of it. Do you think everybody in India, every manufacturer in India should be eligible for this? Right? Don't you think that will be unfair? For example, on one side there is a small manufacturer, on the other side Tata company, Reliance company, Adani group of companies. Do you think interest equalization should be given to both of them? How is it fair? That's a reason. Remember this, right? MSME exporters. What is MSME? Don't worry. Micro, small, medium enterprises. We'll discuss that later. There is under industries, which I believe will take place next week. We'll cover what is micro, what is small, what is medium enterprises. So MSMEs will get assistance here. And apart from the MSME exporters, any other exporter who will manufacture and export 416 products, they will also be eligible for getting the interest equalization. Okay. Under this, the banks give the loans to exporters at lower interest rate, and the difference interest rate is paid to the bank directly by the government. This concept is called as interest equalization scheme, IES. Any doubts regarding this? Let me know. Any doubts regarding interest equalization scheme? Right? Now there is a question here, will it not incur expenses for the government? Of course, yes. Of course, yes. Government is going to incur expenditure, but look at the larger objective. Many of you will be worried, sir, right? Sir, why do we always promote exports? Right? Understand the logic here. Exports promotion simply means, one, production in India is going to increase. Any disagreement, please do let me know. Right? Production in India is going to increase. Second, GDP of India is going to increase. Third, exports increases generally are associated with increasing investments. Fourth, are associated with higher employment generation. Fifth, exports will also bring lot of foreign currencies into India. Lot of foreign currencies into India. So the argument is simple. Government, that's a reason, will keep on taking or implementing lot of measures to promote exports, because promotion of exports has so many advantages. Is it okay? Promotion of exports has so many advantages. Then why shouldn't we export more and more? I have to understand this, right? That's a reason. That's a reason here. Okay. Any other question? Any other question? Any other doubts that you people have? Please ask me the doubts now. Now there was one more question. Sir, should we have gold backing for the currencies? In fact, earlier we used to have it. Should we have gold backing? Gold backing means what? For every 100 rupee that you print and issue, we should have a gold worth 100 rupees. That is not feasible. That's not feasible. Why? The amount of gold that you would require now, because you have printed so many currencies, the amount of gold that you will require is very, very huge. And that much amount of gold, you do not have it. That's a reason. Okay. Nominal and real exchange rate, we'll take it up next week. I've told this, right? Even after telling this, you people will keep on asking question. I said, I will take it up next week. I did not say don't read it. I did not say I will not teach it. I said we'll take it up next week. Please do not worry. I will teach it. You don't have to be worried. Debt service payments. Debt service payments means, imagine you have taken a loan from the foreign bank. Now, when you have taken loan from the foreign bank, will you not pay interest on it? So whatever interest you are paying to service the debt means, right, basically take care of the debt. That is basically called as debt service payments. You have issued masala bonds. You will pay interest on that also. That is also debt service payment. Okay. Closed mutual funds. Closed mutual funds means there is a lock-in period. Lock-in period in essence means for certain time period, redemption will not be allowed. What do you mean by redemption? You will return the mutual fund and take your investment. That is called as a redemption. And whenever closed mutual funds are there, there will not be any redemption for certain time period. That is called as closed mutual fund. Why there should be limit on foreign investors to purchase G securities? Again, same answer. If there is no limit, lot of foreign investments will be there in the G security. And if there's a crisis in the Indian economy, all these G securities will be sold off, dumped in the market. That will create volatility. Right? That will basically affect the volatility in the market. Sir, ECB is a part of expenditure side or revenue side of the capital account? My dear, Indian company will borrow today. That becomes a revenue today. In the same way, foreign companies, if they borrow from India, that is the expenditure side. Or ECB has been taken, you will repay. You have taken in the past, you will repay now. That is ECB expenditure. PLI, I believe you are asking about PLI. PLI will discuss next week. It is there in the slide now, my dear. Right? You're not even seen then. Right? We will take care of it next week. Don't worry. What worst will happen if Pakistan will not efficiently handle BOP? If Pakistan BOP crisis is not addressed, the global market will be affected by it. It will be affected because please understand, right? Irrespective of their political orientation, Pakistan is relevant for trade purposes. I hope you understand. Pakistan is relevant for trade purposes. For example, rice cultivation, ports, etc. So if a country defaults, if the country falls into crisis, there's a spillover effect. Those countries which are having trade will also be affected. Okay. RODTP, will take it up next week. Don't worry, it is there in the slide. We'll take it up next week. Okay. So GST Council yesterday announced compensation to the states. Is it different from horizontal devolution? My dear, you tell me. Compensation, right? Compensation, is it part of the divisible pool? Think of it. Compensation, is it part of the divisible pool? Answer is no, right? Please look at the discussion that we have had. Compensation is supposed to be paid for a very simple reason. States were guaranteed of 100% compensation in case of revenue losses. That is the reason the GST Council is paying compensation. Okay, any other questions? How to revise? My recommendation will be, please make short notes. Please make short notes. Maybe next week or a week after that, I'll give you certain, let's say, concept of a mind map. I'll show you mind maps. Right, so there should be certain, right, let's say, short notes that you can use for effective revision. My recommendation is make short notes, update with current affairs, and revise, solve previous year questions. That's it. That's it. I'll repeat it again. Make short notes, update with current affairs, revise, and write previous year questions. That will take care of Indian economy GS paper 3 for you. Okay. Any other doubts? Right. Which book should I use? You can use any book for that matter. Any one book. Any one book. Again and again, I keep on telling the students like this. Use only one reference book. Trust me on this. Why? Even if you read 10 books, you will get the same idea. Right? So do not worry. Read only one reference book. That's more than sufficient. Rather than reading 10 books about the same thing, GST in 10 books, read current affairs on GST. That is much, much better. Okay, use one reference book plus current affairs. Current affairs as much as you can read from Indian economy. Okay, there are extra topics. If there are extra topics, don't read. That is not relevant. I don't read for GS paper 3. Okay, done then. Okay, let's stop the discussion here today. Next week we will continue the discussion. Right, from where will I start? After foreign trade policy. Right, we'll start from foreign trade policy or after foreign trade policy, and I'll also cover nominal exchange rate, real exchange rate, near and rear next week. Done. So let me stop the discussion here. Right, so take care. Right, read well, revise well, and see you again, right, next Saturday, 12 p.m. Okay, take care. Have a great week ahead. Right, good night.